do not fear if a pullback is near. That's what we got to talk about on today's Stock Market Brief. The SPY hit a new 52-week high, highest it's tagged since the start of the year. And we hit our target area, that white line that was going back towards the August high in the SPY. So the trend remains up. We're going to talk about if a pullback happens, how do we go about approaching that from a technical perspective. All that and more on today's Stock Market Brief. One of the best indicators of the stock market pulling back just arrived, and that's me going on vacation. Although I'm not going to be laying out, I will be fishing. And not that it's bearish when I leave, it's just that when Coco finds out, she takes control of the command center, and things go crazy. Okay, all that and more on today's Stock Market Brief. We're going to hop right into it, get into some interesting charts, interesting macro. We're going to talk about the Qs, talk about the SPY, and so forth. Let's take a look at a snapshot of the market of the products that I track in this market view. We have week to date, month to date, year to date on the screen as far as performance goes. So we had XRT finally creep up positive on a year-over-year perspective. It was up 3% on the week. This is more of a bearish sector that has been bearish here in the overall kind of broad view of the market. So we're seeing a lot of things that have been getting beat down start to see some bounces. As you've seen, the IWM is also up here as one of the best performing index products that we track, up 1.65% on the week. We saw a lot of small cap names get squeezed. Over here, you got the SPY. That was only up about 0.5%, and the Qs was down very, very slightly. So still got some bifurcation in the market. You got some big names taking a little bit of a breather, and when they took a breather, the market really just kind of went flatline. And that's important to note because, well, what happened if Tesla didn't go up 14%? Okay, then the market would have probably saw a little bit more pain. So we have a big cap-weighted name here, big market cap. Definitely helped the Qs and the SPY, as well as the financials, right? The financials also were up 1% on the week, and that's a big weight there on the S&P 500. If we take a look at the rotation, this is looking at the 11 sectors that make up the S&P 500. I'm only looking for the week performance, so 5 trading days is the tail. You got an improving quadrant, a leading, a weakening, and a lagging. It's better when you're over here on this side. But what I'm starting to notice here, just this last week of performance, as the market is cresting into a new 52-week high, what we're noticing here is the defensive names starting to wiggle their little worms over here into the improving quadrant, while the big names like XLK was going from a very strong leading perspective and is just moving slightly there into the weakening area. And then you have XLY, really one name shot this thing way into the leading quadrant, and that would be Tesla. Coming into next week, we're going to talk about a little bit of some macro stuff that's kind of on my mind here that I'm seeing. It's been interesting liquidity charts. So going into next week, we got a whole lot of stuff taking place, right? We have inflation data, right? Inflation data. We have also PPI, and we also have the Fed interest rate decision. Okay, not only that, we got retail sales coming out, and then on top of that, we got Michigan consumer sentiment. And on top of that, we also have some more Fed speak. Okay, so there's going to be a lot of eyes on these reports. It creates a lot of hysteria in the tape when the market kind of comes out, but we can get some really positive trend days. I'm not going to be around, most likely not going to be around to report this. I may come back. I'm not too sure. I haven't really decided how long I'm staying out there in the country. Okay, now overall, let's take a look at inflation. So inflation, it's still high. This is the United States core inflation, right? The Fed has a target goal of 2%, so it still remains sticky up here. Yes, it's coming off. That's good. But if you are a consumer and you're looking at your gas bill or paying for gas, it's still expensive. And if you go to a grocery store, I literally saw a seasoning that I like, a seasoning like, salt, pepper, a seasoning. It was $9.60. Okay. Yes, it was Whole Foods, but still, actually, no, it wasn't Whole Foods. I think it was Sprouts or something like that, but whatever. That's still ridiculous. And no, I did not buy it because I don't roll like that. If we take a look at the Fed Watch tool, the probabilities of the rate hike decision looks to me like it's going to be, well, it doesn't look to me, it looks like to the market, it's going to remain flat, meaning pause. We're at a 5%. Okay, we're going to remain at a 5%. There's a small probability that they move it to 25 basis points. Looking at inflation and how we already, had a huge move in the current target rate, and we probably haven't even felt the effects of that quite yet. Okay, a Fed looks like it may be pausing. Okay, and let's move forward then. So what comes after really we have interest rate, we have inflation data, which could very well interfere with how the Fed is going to proceed, right? If inflation ticks up, maybe this is going to change. Maybe it's not. I don't know, but the market is basically telling us it's going to be flat. With that said, consumer sentiment is pretty much near an all-time low still. So the consumer, we have high inflation, rates are high. The consumer does not feel well about this economy, and it makes sense because you're seeing things like credit cards, right? We talked about this before. Credit card delinquencies, 90-day delinquencies are going up. They're upticking. Auto loan, 90-day delinquencies. Those are serious delinquencies, people. Okay, that means they're like they're not just missing a payment on accident. This is, it's more serious. That's why they say serious delinquency. And then you see auto loan also upticking there. And then we talked about student loan remains flat, but come the end of August, at least as it stands right now, those are going to come back onto the table, no longer in forbearance. They're going to have to make payments. We'll see if that changes. Okay, so you tie on this. This is something that we talked about on these first 2 quarters of deposit outflows or a quarterly change in deposits. We're like, oh, okay, that's not good. Well, then shortly thereafter, we had a banking crisis, and then we had the biggest quarterly drawdown there in deposits. So, credit card balances are going up. Interest rates are obviously high. It's pushing down the consumer. They're not doing great, all right? And what does that entail? Well, it means savings typically is down. It's harder to save money. They're spending more on credit cards. They're starting new credit cards. And what amplifies this kind of behavior? Well, unemployment rate. If the unemployment rate goes from where it's at now, which is relatively low, and starts ticking up, these type of problems, they amplify, and they can amplify very quickly. Speaking of unemployment, we did have jobless claims. If you don't know what that is, it's people filing for unemployment, and boom, that shot up too as well to about a year. This is looking at a yearly time frame, so it's at a year high right now. And then people looking to buy homes, they're doing so. I mean, home prices haven't came down all too tremendously. I'm sure in certain areas maybe they came down more than others, but where I'm at, they didn't really come down at all. And we're having 30-year mortgage rates still uptick right here. So overall, the consumer is pressed. Whether you want to believe that or not, the data is telling us that. And things obviously can take a turn for the worse if some subtle things happen, which would be something like unemployment, or we do move into a recession. How are investors taking this information? Well, they're extremely bullish. So if you take a look at the NIAM, which is just a survey, we're looking at 90% long. When it gets into 100, means they're 100% long. When it gets above that, they're 100. They're leveraged long. But we haven't seen a level like this, rightfully so, right, since the start of 2022, where we met the peak over here. Where boom, that was the last time we were there. That was a peak. And rightfully so, right? The price action's moving up. We built out a base. We're starting to move higher. People are getting really bullish. And this is where contra kind of indicators come into play. So we'll see how this looks here in the near future. And then we take a look at credit growth, right? The rate of change in credit growth. We've talked about this one too. This thing is diving. So not only is the Fed tightening, well, okay, if they pause their rates, all right, well, banks may tighten, and you're starting to see credit growth contract over here. And credit growth contracts prior to every single recession. So you can see all the gray shaded areas, recessions, and leading up to those, you had a contraction in credit growth. And that's not to say that if you have a contraction, you're going to have a recession. But what it is saying is, hey, you might want to pay attention when there's a contraction in credit growth, because there has been a recession every single time, or there has been a recession prior to every recession, I should say. There has been a contraction in credit growth. Oh my goodness. If you take a look at liquidity, we'll look at M2 for that. We'll look at a couple other forms, and this is just looking at year over year, and you can just see just a massive decline that we haven't seen, Okay, this is far back as I can take it over here, probably 1960, and this is just a massive move, obviously, to the downside. You can see the Fed balance sheet has tapered off, but we saw a subtle uptick right there. I know some people like to look at this, some don't, blah, 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 but as it's coming off, liquidity, it's a form of liquidity, and it creates more volatility in the S&P 500. However, when you take a look at something like this, which is other factors draining reserve balances, think of it also as liquidity. It's moving up, it's upticking, and that's also helping the S&P 500 move up there. You can see that actually this was coming off a little bit. And this was happening at the same time where NVIDIA reported earnings. We got some squeezes, so this started to press up. So if this starts to come off and we don't have those, that euphoria anymore, that could be potentially a bad situation. And then I want to point out this chart too. This is the new Bank Term Fund program. And you can see here, this is when it started and we started taking off, and it's still, still moving up here. Okay, so it's still being utilized at this time. And you can see right when it came into play, look at the red line, which is the S&P 500. This is an interesting correlation, maybe to just pay attention to, right? So it moved up, then we just went sideways, we didn't go anywhere. What did the S&P 500 do? S&P 500 didn't do anything. And then as soon as it started upticking again right through here, boom, the S&P 500 really followed that same trajectory. So I don't know if this is going to matter. I don't have that answer, but what I found interesting was, hey, well, it started here, that was the bottom over here, then it consolidated, well, the S&P 500 did too, then it started to move up, and the S&P 500 did too. Okay, cool, so I might as well track it. Let's hop into the S&P 500. Okie dokie. So yeah, we're up slightly on the week. We're disconnected from the weekly 5 EMA. I want to just call out something that maybe you might not see. We are running into, now remember, this is the SPX, okay? So actually in the SPY, this actually crested this high, but in the SPX it didn't. But needless to say, where are we? We are right here, pulling up into an area where we saw prior resistance, prior support. Okay, once support is broken, it can become a level of resistance. Okay, it became resistance, and now we're coming up into it again. And that's right there at 4,300, where we closed at 42.98. We got a little bit above that today, but to be quite honest, if you look at like gamma exposure, it made sense. There was not much above 4,300. So 4,300 was the main strike. You saw price kind of get above it, and then it pulled right back into it, just like that. So we'll see here after, we have a big OPEX next week. We'll see, how things are moved, changed around, and see what takes place. I know I've been hearing some strikes up about like 4,500, stuff like that. So we'll see if that comes into play in the near future on some other episodes. But I just want to call out that, yes, we're getting a little past frothy from the 40-week moving average, which is approximately the 20-day. So a pullback, it's not necessarily something to worry about at this particular time. I'd be more, worried if we start taking out this low or breaking down from 4,000. But as it stands, if you're a longer term investor or holder, even 4,100, like you come back in, okay, we're back at 4,100 where price action was. Okay, big deal. Like, what does that mean? It means really nothing at this particular point in time. So if we start breaking this key level, I'd say 4,000 or the 40-week moving average, then I'd be a little bit more, cautious. And we'll zoom in on tinier time frames to get a good idea of that. If you look at the SPY, we did crest that 431. So 3 episodes ago, we said over here, right around this area, we're like, okay, well, it looks like it can, as long as it stays above that 5-day moving average on the shorter time frames, it looks like we can go hit this, which is about it was like a $3.7 per share move. And well, we tagged it today, and well, price action started backing from that level. It makes sense. It was prior area of supply, so we have supply overhead, and it started backing off from that level. Okay, if you zoom in, you have somewhat of a bearish looking candle. It was unchanged on the day, but it got up, crested a new 52-week high, and it started to back off. But we're still above the month-to-date anchored VWAP. So even if we were to pull back into this chop box, but we hold the month-to-date, that's a positive sign. So watch this right here. If we start breaking this low to basically potentially reconnect with the month-to-date and see how price acts in that area before getting overly too scared, okay? Now, this little shooting star candle was up on a little bit of volume, and then during this consolidation as well, the red day was the bigger volume of those trading days. This one right here, this one was obviously a big volume day too, but that counted as a distribution type day. So there are still some distribution days building, which is not necessarily a great thing, but it doesn't necessarily mean it's bearish until the point where we get some confirmations. Now on the SPY on the 15-minute time frame, we have a new weekly expected move, 422.77 to the downside, 437.03 to the upside. So you can screenshot this if you want to write down these levels. Awesome. Recommend it. And then going into the first trading day, we have our daily expected move, and that is down here at 427. And even if we were to come back down into this area, yeah, we'd get back below the week to date. Well, actually, that was now technically it's going to be last week to date, so this will update, but it'll be right by that 5-day moving average. I want to just call out the 5-day moving average here has held as a level of support. Now, if price action stays down lower in this area, right, we're going to lose some prior data. This data is going to, start to evaporate, but this means if price doesn't get going, this can start flattening out. And if price breaks down from this area and it starts rolling over, goes neutral to rolling over and starts holding as a level of resistance, it could be that's where things could get a little bit bearish and open up the door to the lower weekly expected move, potentially coming in to fill this gap right here. Okay. Good stuff. Let's go to the Nasdaq 100. Nasdaq 100. Weekly time frame. So we've now had 2 weeks disconnected from the weekly 5 EMA. That is actually a rare occurrence. As you can see going back, we'd say, okay, no, there's 1 week disconnected. Here's 2 weeks disconnected. Boom. Okay, so 2 weeks disconnected, and then what? Well, it came back and reconnected with the 5 weekly EMA. So I think that we're going to be reconnecting with the weekly 5 EMA. Once the week opens, wherever that may be, this gets pulled up. Watch for a potential reconnect. Maybe it goes a little bit lower, but maybe you can buy back up through it if we're going to get this continued movement higher. You can see here we are in an area where, well, prior area of kind of a zone, it's a little bit of a zone, right? So we had prior area resistance, a bunch of chop that acted as support, boom, broke through resistance, boom, and now we're kind of pulling up into this area. And as we've shown this on the charts already on the monthly time frame for the quarterly expected move, we are floating basically right at that. If we take a look at the daily time frame, clear as day that this move has not been digested at all. It's been a very strong shot. So to see a digestion or a pullback, and the reason why I say, don't fear it yet, because there's really no reason to fear it. Even if we come all the way back down to 325, what's technically broken? Not necessarily too much at this particular point in time. We need to be more cautious, and we'll tell you how to do that. And we do that by looking at the smaller time frame charts, okay? When you can become more bullish and when not. Okay, the 5-day moving average, notice here, what we talked about the SPY. We start losing data, and now it's starting to flatten out now, okay? As price is flattening out, if price starts getting below it and it acts as resistance, then you just want to be a little bit more cautious, okay? But as it stands right now, we're holding above it, okay? We could very well be flagging right here. Boom, pull, boom. We move up to the upper weekly expected move, but just be aware that the month to date is right here. If price starts breaking below, we could come tag that lower daily expected move, potentially bounce from it, right? That's what we did here. We broke down, we said, hey, be careful, because we can see a snapshot up that can act as resistance. It acted as resistance, came back, right? Same day, boom, stayed there. And then guess what? Because the cash market wasn't strong enough to get through it, guess what they did? Boom, they brought it up, okay? On the aftermarket, they came back, they back tested. So right here in this area, clearly 353, boom. If we start getting below it, it opens the door lower. As long as we hold above it, that's bullish, and it could open the door still to this prior area resistance to come up to here, which is right around this prior area of resistance. All right, everybody, let's look at some indicators now. I got to go through these pretty quickly. I have commodities, bonds, and yields, so I'm going to try to pick up the pace here a little bit because I got to get ready to take off. If we take a look over here, this is growth to value, rate of change. I'm just calling out what I see. We're going into that negative rate of change area. I highlight it on the screen every time it does. We've seen some sell side. Last one was right here where we went down a little bit, but then we crossed back above. We had that negative divergence over here, and we're crossing back below. Marked some big movements to the downside. As you can see, one was right here, one was right here. So just be aware that we are crossing down. If we look at smart money, bonds, HYG, high yield, versus the dumb money over here in the equity market, yes, we've been having some negative divergences, and they've been playing out too. So you can see a high to a lower high, a high to a higher high in the dumb money, right? Boom. Boom. And then what's that tell us? Well, smart money is telling us, we're not quite, believing the markets overall. Bam. Guess what? The SPY falls down. Okay, well, on a bigger time frame, let me redo that. On a bigger time frame, you have a high to a lower high. Is it a lower high? Yeah. No. Oh my gosh, I'm grabbing the wrong thing. Okay, so high to a lower high. Yeah, it's slightly there, matching highs, but a very clear higher high over here. So smart money isn't quite following this move yet. That could be a divergence or telling us that, hey, we may be pulling back, but not to fear. Okay, we'll go into some more bullish charts indicators here too as well. One being the Saylor to Schiff tool is above zero still at 0.45, so not by much, okay? But this means that we have the opportunity here if on the new candle that forms, I think it's forms at like on Sunday, I forget the exact time, or late night Saturday, when the new weekly candle opens up, what you need to have happen is price action on that weekly candle has to cross above the high of this prior week, which is about 27,500, I believe it is, right around there. Okay, and if it doesn't, well, then as long as this holds a buy signal, well, then we just kind of keep following it to see if it does. If this crosses back down through, then it means we get a no trigger, okay, which we just had one right. Actually, yeah, we just had one right over here where it crossed to a buy, but when we didn't get the weak cross above it over there, and it kept on kind of going down. Now, on a bullish note, we had this potential change in trend take place over here. Excuse me. And the market continues to go up, and it's still a nice spread. If this summation index starts crossing back down below, maybe we'll take more notice and say that there can be a potential change in trend then. On the summation index for the New York Stock Exchange, a broad market as well, this is still pointing up, and you have the parabolic star over. So even on a pullback, as long as this can hold, that could be a positive sign. We can get a little bit more, more concerned if the parabolic star starts ticking up from that. Bullish percent index for the Nasdaq Composite, still in that overbought condition. NIA, right? This is the New York Stock Exchange in that overbought condition in the bullish percent index. Discretionary is pointing straight up. Looks like it can make there pretty soon into an overbought condition. And then technology, bearish divergence did play out to the downside ever so slightly. Okay, but this thing could always come back up, and we could still have another negative divergence that forms, okay? So that's always a possibility. I'll continue to watch that. Commodities, not looking great, right? So oil took another nose spill, which is not good for energy stocks, which is not good also for the IWM. You saw a little bit of weakness in the IWM, just really digesting its gains from this last big two-day move. You have copper also putting a longer topping tail, so confirmation would be if you start getting below that, could be bearish, and you have the lower high there. Excuse me, in copper, higher high in the S&P 500. We've called out those divergences there before. Gold is still consolidating here after this breakout. So if we start getting back above the high, or getting back above 2,000, I should say, that would be more bullish. If we start getting back below 1925, that would be proceed with a little bit more caution. If you take a look at Bitcoin, we're still below that 50-day, 20-day. You can see the two candles over here are kind of coiling up tightly. If you see it on the weekly time frame, you can see it a little bit better. Okay, it does look like it's flagging, and it's flagging where? Right at a prior area of support. Support then becomes resistance. So it'd be nice to see if we can get back above 30,000. That can open the door for a quick pop to the upside, to potentially even into this area around 35,000 to 37,500. I would like to see a confirmed buy signal, and then I'd start looking into some of the crypto equities, and obviously crypto if you trade the crypto itself. Okay. But Bitcoin and yields. So we now have a lower inversion there on the 10 and 2 yield curve. Not a new yearly low, right? We went over 100 basis points inverted, and this thing's still pointing down. So I mean, this is not it's not healthy. This will become uninverted at some point, right? You can't. It's not going to last in inversion for that. I'm surprised it's still here. Okay, but it is. That's the reality. When it uninverts, that we've seen some pretty nasty stuff happen in the marketplace throughout history. So we'll keep continuing to monitor this, but it's not a good thing seeing this. Okay. Along with all that macro data that I've been showing you. If we take a look at the 10-year yield, looking at the TNX, this is looking pretty crazy to me, actually. It looks like it's just like bumping its head up, coiling up. And if this thing starts to fire off, I mean, that's not a positive. That's not good, right? So not only would bonds go down a little bit, right? And they've been just kind of sideways, but if the 10-year yield starts breaking out, that's not good for growthy names at all. And the 30-year mortgage tracks the 10-year yield fairly well, strong correlation. So if this starts moving up, I mean, houses or money to borrow will become more expensive. Let's take a look at the dollar. The dollar is also just consolidating, very similar to gold, okay? We know about the negative correlation here, so if the dollar starts firing off, be careful, because that can also lead to a pullback here, but then also lead to a pullback in other various commodities as well. Remember, this one day, this move right here, boom, this big down day, look at the S&P 500. It actually had a big up day on that. So I went back to the correlation chart of the dollar and the S&P 500, and we're looking at different time frames. So 15-day correlation, 30-day, 90-day, 120, 180, and you can see the longer you go out, it has been negative. And typically, even from the shorter perspective, it remains negative. The last time I talked about this chart was when we were up here, and what I said was, if I could bet on this, one thing's certain, we're going to go back to a negative correlative state. The probabilities are very high for that. And now we're starting to move. Now we don't even have a correlation. 15-day correlations at 0.02, okay? It's starting to move back into a negative correlated state from the shorter time frame, which means the 30-day would start rolling over too if this starts going down. That means also it would get deeper into negative correlated state there. And if that is the case, and that does happen, which it seems like it's taking place, that means that if the dollar does move higher, that means there is a higher chance that the S&P 500 goes down, pulls back, digest, whatever the case is. So just to recap for all the people that say, you're bearish, you're so bearish, I want to reiterate on the shorter time frames, when you are above that 5-day moving average, we're looking good. But if it starts to neutralize out, and then that's when the trend becomes neutral on the shorter term, and then it starts to decline, then you want to proceed with caution, okay? And then up until the point wherever price goes, who knows, if price gets back above it and the 5 days starts trending back up again, things are on once again. That's all I got for you. See you later.